Well, hello, everybody. My name is Garrett Schmidt. I am the managing editor for BBC Exhibit Hall, and I'd like to welcome you to today's live webinar hosted by Summit Reinsurance. And it is a two-part series, which we're really excited about. And the title is Don't Let Downside Risk Get You Down. Effectively right-sizing your risk exposure, part 1. And there's going to be another part 2 that's coming up on October 5th, and we're going to send out a link later on to where if you wanted to find out more information or register, you can do that. But we're glad you joined us today. A couple items of note before we get started. Everyone has joined today in listen-only mode. This is a traditional webinar format, so we can't see you or hear you, but we do want to hear from you. So we're going to have a time for some Q&A kind of towards the end of the presentation where we'll take audience questions. But you don't have to wait until then in order to actually submit your question. So if you have a question that you would like to ask one of the speakers or in general, just go ahead and use your control module. There's actually a little place for questions, which is different than the chat. So keep that in mind. There's a little question module. So submit those. So we're going to get to as many as we can. If we don't get to yours, don't worry. Someone will reach out via email afterwards and address your question. Finally, the session today is being recorded. So when we're done, one of us will send out a link to the recording where also you can download the slides and find out some more information there. And that'll be a link that you can actually share with colleagues and friends. We hope that you do so that we can get the word out. But without further ado, I wanted to briefly introduce our speakers today. First of all, we have Mr. Rick Lasso, and he is the VP of Underwriting and Actuarial. And then we also have Mr. Scott Mahout, and he is the VP of Sales for Reinsurance and Provider Excess. So welcome, gentlemen. Happy to see you here.
Great, glad to be here, Garrett. Thanks so much. And for all of you folks that are participating, I really appreciate your time today. As Garrett said, this is the first of a two-part series called Don't Let Downside Risk Get You Down. And it's really designed to be a bit of a one-on-one session for providers that are either contemplating taking risk or perhaps considering taking more risk. So what I'd like to do is just share a little bit of context first. So we've been members of the National Association of Accountable Care Organizations, also referred to as NACOs, for several years, and it's really been a great organization for ACOs, but really for provider organizations of all types. They learn best practices from each other, and it's a great forum to be able to stay at the forefront of industry education and regulation. So we've exhibited for several years in a row. Conference again is coming up next week in Washington, D.C. So hope to see many of you there. So we've been able to witness really firsthand the positive impacts of value-based care and the resulting desire and really the improving comfort level that provider organizations have with taking on more risk. But as we all know, being in this industry, the more risk that's being taken, the greater need there is to understand what those risks are, how they're being borne, and what options there are for managing them. So as we head into quoting season here, like I said, we're offering this two-part webinar, Don't Let Downside Risk Get You Down. And this first part is about understanding the risk. So you can see the title slide there. And then part 2 is going to focus on the process and the detail that you need to go undertake as far as obtaining a provider excess quote on the private market. And as Garrett said, that session will be held on Thursday, October 5th at 1 p.m. Eastern Time in this same forum. So Tammy, we can go ahead to the next slide. So I'd like to start just by noticing that CMS, so Centers for Medicare and Medicaid Services, their vision by 2030 is essentially for all providers to have some skin in the game. So while I'm about to share the CMS roadmap with you, it's important to note that the benefits of this value-based care journey really translate to all product lines, Medicare, Medicaid, and commercial as well. So it is important to keep in mind, however, that CMS really continues to be the catalyst behind a lot of the risk sharing that's going on. So if we go to the next slide, Tammy. Thank you. And I'll go through this fairly quickly, but going back to 2012, we've got the Medicare Shared Savings Program and Pioneer ACO models that were introduced. Then in 2016, we get to the next gen ACO, which again, that moves selects ACOs to greater risk-bearing arrangements. We arrive at 2021, and that's where the direct contracting entities or the DCE model came into play, which evolved, as we know, into the ACO REACH, which I'll talk about in just a minute. But here we are in 2023, and under the MSSP programs, we have 456 ACOs representing roughly 11 million beneficiaries. And it's just interesting to note that if you look at the percentages below, we've got one-sided arrangements, which are upside risk, so you're sharing in the gains, and you've got the two-sided arrangements, which are both upside and downside risk. So the providers, through their value-based care arrangements, are sharing in both, both gains and losses. And it's interesting to note that looking at those percentages, roughly 2/3 or almost 2/3 of those entities are taking really substantial risk through track E and then the enhanced track. So we're talking 30%, 40% or more of downside risk. So anyhow, just as a quick aside, I've always gotten a kick out of the reference to upside risk, because it is a bit of an oxymoron. I don't know if any of you folks have gone to Vegas. I've been there a few times, but I will have to go next time and ask them where the upside risk tables are, because I sure haven't been able to find those. So anyhow, why don't we go on to the next slide, Tammy? So just real quickly, I want to touch on just the types of risk-taking provider organizations that we're encountering. This by no means is an all-encompassing list, but it does represent many of the types of organizations that we are running across and are working with on a regular basis to help them evaluate their risk and also determine the best way forward from a risk sharing standpoint. So obviously you've got ACOs, hospital systems, integrated delivery systems, physician groups, etc. But like I said, there certainly are many different types of additional provider organizations that we continue to see that are moving to risk arrangements as well. So now I'm going to turn it over to Rick Lasso. Tammy, you can go ahead and advance the slide. And Rick will talk about the scope of provider risk taking.
Great, thank you, Scott. So what I'm going to talk a little bit about here is scope in terms of covered services in some of these risk-taking arrangements that we see, as well as getting a little more into the detail of upside and downside risk, and then what are some of the when you're in a downside risk arrangement, really what is driving that risk. And the reason I want to go through all this is because this is all, understanding all the details of these arrangements and how these can change is important in assessing options for mitigating risk, which is what Scott will be getting into when I turn it back over to him. So first, in terms of the scope of provider risk taking, you might recognize this in some of the risk deals that you might be in. There's a few different ways these can be structured. The first is the simplest, which is just a full or global risk arrangement, where essentially the provider is at risk for essentially all health services provided to the patient. Personal risk arrangement would be where this might be if it's a physician group taking the risk. Maybe they only want the professional risk. It could be a hospital only. Sometimes it could be in-network only. Maybe we're only taking risk on services provided at our own network hospitals or network facilities. There's also a variation of this where there's risk taking on specific bundles, like an orthopedic bundle or specific episodes of care, like a cancer episode. Another variation on this scope of provider risk taking could be a shared risk arrangement. Often you'll have an affiliated hospital and affiliated physician group. They would jointly enter a global risk arrangement, but then there would be a document, a division of financial responsibility, or a DOFR document, which will typically outline which services are the hospital's risk, which services are the physician pool's risk, and if anything is retained by the original payer, then that would be identified also. Often we'd call that, if something was retained by the payer, we might call that a carve-out. And it's important to understand carve-outs again, because when you're talking about risk mitigation for downside risk, it's really real important to understand what are you actually at risk for, so that, for example, if you're not at risk for gene therapy or for transplants, next slide please, then you might, you obviously don't need to worry so much about mitigating those risks. So a couple carve-outs that we commonly see, either by choice or by design. So transplant risk, often carved out, meaning that the provider may not be at risk for it, either because the payer is retaining it, or possibly the provider wants to pursue a sort of a unique risk mitigation measure for transplant. This used to be more common when transplant risk was a major driver of large claims, but you would seek transplant programs where you could contract with a center of excellence type of model for managing transplants, which certainly if the risk-taking provider already has that capability, then they're not going to be too interested in a carve-out. But there's situations where it might be appropriate to use a transplant carve-out as a risk mitigation approach. More recently, gene therapy carve-outs are starting to gain some traction. I haven't seen that yet as much in the provider market. This is more in the employer. It definitely exists in the last couple of years in the employer stop-loss market. I'll be curious to see whether in the next year or two we see more of these gene therapy carve-out products being marketed to providers. Next slide, please. More broadly, we do often see RX carve-outs. Often this is by design. So often the payer will retain RX risk and will only be delegating the prescription drug risk to will only be delegating services other than prescription drugs to the hospitals and physicians. Also, common in a Medicaid program where Medicaid is the ultimate payer, common for the state to retain risk for drugs, or possibly just specialty drugs, or possibly even just gene therapy or specific named therapies. So again, very important to understand for these high dollar therapies what your ultimate risk exposure is, so that you pursue appropriate mitigation. Part D also, Part D doesn't cover quite so many of the catastrophic, gene therapy generally doesn't fall under Part D, for example, but you can get some significant expense in Part D, and often that is not transferred to the provider because Medicare Part D, the program itself, has a catastrophic reinsurance type mechanism built into it that's administered by CMS. So we actually see this all across the board with payers. Some payers, when if you have a Medicare Advantage plan that is delegating risk to providers, we see some Medicare Advantage plans that insist on keeping the Part D risk because they don't think it's appropriate because they don't have the risk themselves, they don't think it's appropriate to delegate that to the provider. We see some other Medicare Advantage plans that absolutely think it should be delegated to the providers because it's an important part of spend. And then we see some that are willing to do it either way. Next slide, please. Actually, the slide after this, which we'll turn to in a second, it will include a graphic that from the Healthcare Payment Learning and Action Network, which describes in a little more detail some of these different alternative payment models. But that's a pretty busy slide, so I wanted to establish this framework first before moving on to that slide. So we could categorize payment models into two categories. The first would be payment models with no risk sharing, of which we've identified two here. The first is fee-for-service, your traditional payment model. Doesn't really fall under the value-based care umbrella at all. And then the second being what's sometimes called a pay-for-reporting or a pay-for-quality reporting, which is sometimes the first stepping stone to financial risk sharing. So I would, for the purposes of the presentation today, I think we would say that there's not really any risk sharing in those models. Where we start getting into risk sharing is in the second category, which includes both upside only models or one-sided cost of care models, and then upside and downside or two-sided cost of care models. When it comes to risk mitigation, Most commonly, we see that mitigation is necessary in these two-sided cost of care models. So if you're worried about the potential for losses, that's where you might, as a provider, we see that you might be interested in, reinsurance or caps or something like that. Although we sometimes see that for upside-only contracts as well. Also, any of these options might include financial incentives for quality outcomes. So that's not unique to downside risk necessarily. Next slide, please. So as mentioned, this is a graphic that shows sort of a continuum from left to right, and they put it into categories. So category 1 was that fee-for-service. As mentioned, no value-based care component really at all in most fee-for-service arrangements. Category 2 is that, beginning, taking a stepping stone. So there might be, pay for reporting, there might be pay for performance, but it's all quality related. It's not cost of care related. It's once you get into category 3 and category 4, this is where we get into what CMS is targeting, where they really want to put have every patient in a risk contract. It's more of this. It's actually more category 3B and 4. So 3A is just upside only. 3B is upside and downside, and then category 4 is even taking a step further and moving from you can think of category 3 as being a retrospective reconciliation model. So you establish a budget for where claim costs should come in, and then at the end of the year, you do a retrospective reconciliation. Whereas category 4, this population-based payment approach, this is more of what we sometimes call a capitation-based model, where there would be often a payment upfront, which gives the provider a little more cash flow flexibility, and then has funds available to invest in programs to help manage episodes and chronic conditions and catastrophic costs. So the further you go to the right on this scale, the more likely risk mitigation might be necessary. Next slide, please. Again, this is from the Healthcare Payment Learning and Action Network. Just the state of the market. This is sort of building off of what Scott mentioned earlier in terms of how CMS is driving the transition to value-based care here. You can see, you can see the lines of business across the bottom: commercial, Medicare Advantage, traditional Medicare and Medicaid, and then each cylinder is color-coded. The dark green and dark blue, purplish cylinders, those are categories 4 and 3B. So those are your two-sided or upside downside risk models. You can see that for Medicare Advantage, a little more than a third of the market, and this is a couple of years ago, so it's almost certainly higher today, but a little more than a third of the healthcare spend was flowing through two-sided models in 2021 for Medicare Advantage. Traditional Medicare in 2021 was a little further behind, although I would have to believe that's significantly higher now with DCEs and Reach ACO growth the last couple of years. And then Medicaid trailing about 17%, largely, I think a lot of that's probably in California, where this has been common for years. And then the commercial market is sort of lagging in this, but may catch up at someday. Next slide, please. Now turning attention to getting, we're going to get a little more into how, what kind of risk we want to be mitigating if we're in one of these downside arrangements. So I wanted to put this graphic up again just to visually illustrate how one of these two-sided arrangements works. Typically, you've got a budget, or it could be called a benchmark, or it could be called a capitation rate, but whatever it's called, that's the amount, that's the target. We would like healthcare spend to be certainly no greater than that, and ideally less than that. Often there's a quality component tied to this as well, maybe a member experience or a patient experience component tied into it as well, so that maybe some of the, if cost comes in higher than the budget, then there's shared losses. If cost comes in below budget, then there's shared savings, but often those shared savings are contingent on meeting certain quality outcomes as well. Risks that providers might want to mitigate, how is it that you would end up in a shared loss scenario? Often we think of this as there's a utilization risk and then there's a large claim risk. The utilization would be is there waste in the system? Is there overutilization? Occasionally there could be fraud type issues, although That tends to happen more at the payer level than at the provider level. Risk mitigation measures exist to address utilization. And then separately, if you're worried about large claims, then you might want to take there's a different set of tools available. I just listed here a few of the more common reasons for large claims. I do want to focus a little bit on gene therapy because that's a hot topic. And so we'll spend a couple minutes talking about gene therapy and how that might be affecting or changing the degree of risk, degree of healthcare risk going forward. So next slide, please. I hear a lot about a gene therapy tsunami. There's a lot on this slide. I won't read everything on here, but certainly this is yours to take away, and happy to field questions. Gene therapy has been around for about 6 years now. The first therapy was approved in 2017. That was Luxturna, not super expensive, about $800,000. Then Zolgensma in 2019 is about a $2 million therapy. Then there was a little bit of a pause. There was, between 2019 and 2022, there wasn't a lot of activity. This is when people started talking about the coming gene therapy tsunami. Roctavian was originally potentially going to be approved in 2020, but was delayed. The FDA wanted additional evidence. And so that was sort of the first inkling that maybe the tsunami wasn't coming quite as fast as people might have expected. Second half of 2022, 3 gene therapies were approved, and they were all approved at a significantly higher cost than Zolgensma. Zolgensma, again, was about $2 million. These 3 gene therapies that were approved in 2022 were closer to the $3 to $3.5 million range. So significant cost, although none of those 3 therapies really has the potential for significant utilization compared to other catastrophic claims that are already out there. So again, approvals have started to pick up, but not entirely clear that there's a tsunami or a wave on the horizon. Now, we do hear that the FDA is potentially going to approve another 6 or so therapies in the next 18 months. Some of those do have the potential for significant utilization. For example, the sickle cell disease therapies, and actually the Duchenne muscular dystrophy therapy was recently approved. So that there could be some utilization there. I thought it might be interesting to take a poll of those on the call here. If you could advance to the next slide, please. What do you think? I actually gave a version of this talk at the Society of Actuaries conference a few months ago, and we got the opinion of some health plan actuaries of what they think. And I'll be curious to see how the results here compare to that. So what I'd like to ask for some participation here on is, do we think option 1, the gene therapy tsunami, is real, and in the next 5 years it will lead to at least one major change in U.S. healthcare financing? So option 1 is it's a big deal, and it's so big that we're gonna have to make some changes to absorb the impact. Second option is the tsunami is real. We're going to continue to approve these therapies and administer them at an increasing rate. But even if we do have 3 times as many therapies or 4 or 5 times as many therapies approved in the next 5 years, our current healthcare financing system is robust enough to absorb that. It'll just be another component of healthcare trend that we've been complaining about for years, and is potentially unsustainable, but not really going to lead to major change. Third option would be the tsunami is a little overblown. 5 years from now, we're going to have about as many therapies administered as we do today, maybe 2-3 times as many, but it's not going to be an exponential growth curve, and it's not going to lead really certainly to any major changes. Fourth option would be not sure. So thank you, Garrett. Please take some time to, well, I'll turn it over to you if you want to give instructions here.
Yeah, sure. So I just pulled up the poll, and so go ahead and select one that you think, and we'll give folks just a minute to do that. Still got some answers coming in, or some results coming in, so we'll keep it open for about another 10 seconds. 9, 8, 7, 6, 5, 4, 3, 2, 1, and we're going to go ahead and close it out, and then we'll share the results so we can speak to that. So I'm going to go ahead and close it out now. All right, and here we go. Rick, are you able to see that?
I am. Thank you very much for administering that poll. So interestingly, the results here are quite similar to what we saw in the provider community seems to be in line with the health actuaries here. We've got about a 50-50 among the people who have an opinion, about a 50-50 split between major changes coming and no major changes coming. But there weren't very many people who in either group who thought it isn't going to happen. So great to see some consensus there. Not sure. I mean, not sure. 35%. That's significant. I mean, that I definitely agree with. There's some uncertainty here, and yeah, if I was placing my bet, I would say no major changes, but I also would have a healthy dose of not sure in my because a lot can happen. So thanks for participating in that. Let's move on to the next slide, please. I wanted to just make a couple of remarks about a line of business specific impact of these, cell and gene therapies, gene therapy mostly. On the commercial side, and again, there's less commercial value-based care than there is Medicare and Medicaid. But on the commercial side, payment rates are so high. There's a lot of reasons for $1 million hospital stays already. So adding gene therapies are going to add to that mix, but I think it's going to be a lower impact for commercial than for the other lines. Next slide, please. Medicare, I think we'll see a moderate impact. Payment rates, while they are lower for Medicare than for commercial, which means there are fewer $1 million claims for Medicare certainly than there are for commercial, far fewer. Catastrophic claims in Medicare are driven more by specialty drug and by cancer in particular. CAR T therapy, which is not quite the same flavor of gene therapy as Zolgensma, but a CAR T therapy is certainly contributing to cancer spend. And I think if you include CAR T in the mix, then there's a pretty substantial impact on Medicare, especially as some of these CAR T therapies might get approved for second or first line treatment. Next slide, please. Medicaid, you can see all the dollar signs here. This is where we see the biggest impact, and especially for Medicaid kids. So many of these gene therapies are targeted to a pediatric population. Medicaid has even lower payment rates than Medicare does. $1 million claims are more common than they are for Medicare, but really, primarily it's premature infants or NICU stays are the primary driver of $1 million claims in the Medicaid space. Adding in these gene therapies, I think, will significantly increase the number of large claims we see in the Medicaid space. So if I'm thinking about what line of business am I most worried about from a gene therapy perspective, I would say Medicaid plans and then providers taking Medicaid risk are probably most exposed to the gene therapy risk in the coming few years. Next slide, please. So whether it's gene therapy or whether any of these other reasons for large claims, I just wanted to talk briefly about how real is this risk of large claims. What we have on the right here is a graph. This is an actual claim distribution for a health plan in 2021. Each of those tiny vertical bars that are different shades of blue and green, each of those bars represents one large claim. You can see this health plan was quite unfortunate to have a $10.6 million claim that year. That is an extreme outlier. So a $10.6 million claim, that might be, depending on the size of the health plan, that could be a 1 in 20 year event or a 1 in 50 year event. I mean, it really depends on the size of the health plan, but that's not going to happen very often. They were unlucky they had that happen that year. For this health plan, I drew that line at 1.5 million because that, claims above 1.5 million are pretty rare. So we might define the size of a large claim for a health plan to be 1.5 million, or a health plan of this size. Now, if a provider is taking risk from this health plan, that provider is certainly only taking a subset of the risk. They only, their patient panel is likely only a fraction of that health plan. And I've indicated, they could be Section A or they could be Section B. And, some of the patients that are that provider's risk, a small number of them might have large claims. but those large claims are probably not going to be the same magnitude as the health plan's large claims. It could be, that $10 million claim, which might be a 1 in 20 year event or a 1 in 50 year event, could be a 1 in 200 year event for a provider, or a 1 in 500 year event. So the definition of large claim certainly matters. It's important when we're assessing risk here to think about, okay, how large is the population, and what risk are we really talking about? Because if you take a look at this health plan, it looks like they have about 30 plus claims over $500,000. So they wouldn't really consider a $500,000 claim to be a large claim. But for a provider taking risk, they might actually consider that to be a large claim. That might, that risk might need to be mitigated. Next slide, please. Turn it back over to Scott here to talk about risk appetite and options for addressing.
Very good. Thank you, Rick. And actually, I just want to go back. We don't need to go back to the roadmap slide, Tammy, but I neglected to mention also in 2023, obviously, reach ACOs came to be. So that was the evolution of the transition from the DCE model in 2021. And as I'm sure many of you are aware, ACO REACH stands for Realizing Equity, Access, and Community Health. And there is substantial risk in those models, both upside and downside, perhaps up to 100% or full risk. So now turning our attention to risk appetite, there's some really important questions, obviously, that every organization needs to ask themselves. The first being, how much risk do I have today? Have you quantified it? Can you quantify it? What are the requirements? Whether there's payer truncation or carve-outs of some of the types of expenses. How do they impact the risk that you have? Secondly, what's my risk tolerance? How do you feel about the amount of risk you have? And maybe just as importantly, or more importantly, how do your owners feel about it? And then you need to consider, okay, what are my options for the risk that I need to mitigate? So if you've got more risk than you're comfortable with, what are your options to managing it? So obviously, you can elect coverage from a payer, whether that be CMS or a health plan or insurer. Or you can explore third-party provider excess coverage. So that's the PXS, is provider excess. And as we go to the next slide, excuse me, the next couple slides, actually, there are a few different ways to go about this. So there's aggregate coverage, which is an insurance policy that pays out when the claims for all covered members in the aggregate, hence the name, exceed. In this example here, we're just selecting 105% of expected claims. So very simple math here. The way that works is you've got, if you have expected claims of $1,000 per member per month, 100,000 member months being covered, that equals expected claims in total of $100 million. So reinsurance may kick in, or the insurance, I should say, would kick in excess of $105 million up to whatever amount of insurance was purchased. So there are a few, very few, actually insurers that are offering aggregate coverage, but it's primarily for the MSSP and the participants and the REACH ACOs. The aggregate coverage that we've seen has been very limited to those product lines. So for commercial, for example, we've seen it offered, but for the other product lines outside of MSSP and REACH ACO participants, it's very difficult to come by. Next slide. So in addition to aggregate coverage, we can look at specific coverage, which is really our focus today for the remainder of our presentation, and will be the focus for part 2 of this webinar series. So a specific coverage is an insurance policy which pays out when any specific member, again, hence the name, the specific member's total annual claims exceed the deductible. Again, very simple example here. If the deductible is $500,000 per person and you've got 10,000 members covered, let's say all but 3 of those members have claims below $500,000, so we don't need to be concerned about that from an insurance standpoint. So here you've got 3 members that have claims of $550,000, $750,000, and $1 million. So the insurance policy would reimburse $50,000, $250,000, and $500,000 for a total of $800,000 of reimbursement excess of that $500,000 deductible. So for specific insurance, specific excess insurance, there are select insurers that offer this coverage in most jurisdictions, certainly more than, many more than are offering aggregate coverage. But then there's also this notion of using captive insurance companies, which we are seeing, quite frankly, a lot more activity lately. So this is where the ACO, as an example, the provider organization may be part of a health system parent that has their own captive insurance company to utilize and to absorb this risk. So I'll just talk a little bit about that. If we could go to the next slide. Thanks. So here's just a very simple graphic of what that would look like. So like I said, in this example, say there's an ACO that happens to be, its parent is, they're owned by their parent health system, and the health system happens to have a captive in place primarily for their medical malpractice or their hospital and professional liability coverage. But there definitely are many more types of coverage that can be contemplated to be put into that captive. Could be health plan risk to the extent the parent owns a health plan. It could be their own employee risk could be put into that captive, or it could be a whole host of other, payer value-based care arrangements across various member types. So with the captive situation, you'd have within the parent organization, that's kind of the blue and green box, perhaps the first 250 of that risk for P&L purposes is retained by the provider, and then a larger amount of risk, up to 500, let's say in this example, can be insured by the captive, and then you can still, at that point, you can still obtain unlimited coverage excess of $500,000 from the reinsurance marketplace. So now that exposure is now opened up to much broader, the much broader reinsurance market as far as absorbing some of those risks. So it's something that we're seeing a lot more of. I can tell you a handful of years ago, it used to be the case that we would find that the parent organizations and the their subsidiaries, there wasn't a lot of communication, quite frankly, even at the financial level, between the health plans and their parents, or even the ACO organizations and their parents. And we're seeing much more collaboration, probably out of necessity, costs, it's certainly, much more collaboration between the organizations, and also a look across their operations as to how they can be more efficient in going about managing their risk. So some of the other reasons why you might want to consider a captive is as you pool these different types of risk, that provides greater diversification within the captive. You avoid premium tax. Like I said earlier, you have access to the much broader reinsurance market for coverage. And there are, the way you structure the coverage within the, within the captive can be very specific to different lines of business. While, like I said, still protecting the captive overall against catastrophic risks of the type that Rick referred to in that large claim site. So why don't we go to the next slide? I'm going to turn it back to Rick here, just for this one slide, to talk about payer truncation versus commercial or third-party provider access.
Thanks, Scott. So yeah, this is a, when we talk about how to mitigate this risk of large claims, and Scott mentioned there's two options on that specific excess front. There's the payer truncation option, and then there's a commercial or third-party provider excess option. Again, I won't read through all the text here. I would invite you to, if you're interested in this topic, I invite you to take a look at this on your own time, and certainly happy to answer questions if you do have any. But I wanted to highlight a few of the more commonly, more common barriers. So as we're talking to potential clients, what are some of the barriers that more commonly arise where they might say, yeah, I'd really prefer to go with what the payer's offering. I'm not really interested in a third-party option. versus what are some of the reasons that they might say, boy, I'm not really interested in what the payer is offering, and I do want to go out and potentially look at getting a quote from the commercial market. On the payer side, a couple of the advantages there that come up most often are, well, one is that in some cases it's required. So if you're in the Medicare Shared Savings Program, you cannot opt out of the payer truncation that CMS imposes. So there's not really a third-party market there. But aside from that, one of the primary advantages of the payer's approach is that typically it's lower cost because typically the payer is not including any expense margin. So often, if you're going to compare what the payer is offering to what the commercial third-party market is offering, often you're going to find, with same terms, often you're going to find a better deal from the payer because often they're not loading it for expense margin. Now, sometimes there's a pooling approach, and sometimes if you're way more efficient than the pool, then maybe you can still get a lower rate if you go to the market, but it has to be enough to overcome the the margins in the private market. So for a lot of our clients, we find actually the payer's offering you a pretty good deal. You might want to consider that. Some of the situations where the third-party provider access could be a better solution would be, for example, if the terms that the payer is offering are complicated or difficult to understand. And this recently came into play with the Reach ACO clients, where CMS has introduced an optional truncation approach, which essentially assigns a different deductible to each member based on their risk score. So the more and so it's difficult to keep track of what each member's what your risk exposure is for each member, and it's difficult to understand it and difficult to keep track of it. Another potential reason that we often see is the payers don't always offer as much flexibility. So particularly for providers that have multiple risk arrangements, they may find that combining those into a single provider access policy with a higher attachment point or a higher deductible is a benefit to them, because it's rather than having 5 or 6 different payer programs, each of which has a different deductible, and all those deductibles are lower than because when you take the payer truncation, you're giving up shared savings opportunity because you don't have the opportunity to beat the benchmark on those claims. So if you feel like you're in a situation where you're ready to take on more risk, sometimes the third-party provider access market can help you out there. I'll turn it back over to Scott to wrap things up here.
Sure. Yeah, and I'll just add on to that slide real quick, Rick, that what we see when we're evaluating the payer excess options versus what the commercial market, ourselves included, might offer, at least 2/3 of the time, the payers, because of the terms, like you said, that they're offering typically much lower deductibles, they have the data, so they know they know where they want to price it. But about 2/3 of the time, the commercial market winds up being a better option. Plus, with the commercial market, you do have an opportunity to return some of the profits if you have a good year via an experience refund, where we're not seeing that typically with the payers. Not to say that it never happens, but oftentimes the level of deductible that the payers are choosing is quite a bit lower than what the provider organization would like to keep, or is comfortable keeping. So anyhow, just in summary, I want to make sure we leave some time here for Q&A. Really, the key notes here, the key points that we want to share with you are: number one, CMS continues to really be the catalyst behind value-based care risk sharing. It definitely extends to all product lines, and as we've shared with you today, as a result, it's led to many different types of provider organizations getting much more comfortable taking risk. The downside risk is real, though. However, as Rick pointed out, we're not trying to scare anyone or being alarmist, but the gene therapy costs are real. We're paying on those claims. We've seen a handful of Zolgensma claims, et cetera. So they are real, and it does introduce a new level of potential volatility, because you just don't know which provider entity is going to be the one that has that member that has the $2 to $4 million claim, or perhaps even multiple claims. And but the good news is for downside risk, there are provider organizations, or for provider organizations, that the risk is insurable. And as we talked about, you can either purchase specific protection or aggregate protection or both. And we have seen in some cases both of those coverages being purchased, typically earlier on in the provider organization's risk-taking journey. They may want for the first year or even into through year two, an aggregate cover until they can see how things are really playing out. It may be the case also that the board or the owners are requiring aggregate coverage to be in place. So there are occasions where both aggregate and specific coverage is purchased, and then after a couple of years, the aggregate is dropped and they keep the specific. So why don't we go on to the next slide? We can engage in some Q&A. It looks like we've got about 10 to 13 minutes left. Before that, I just wanted to reiterate the follow-up webinar is going to be Thursday, October 5th at 1 p.m. Eastern. Again, the same kind of forum, and I won't walk through all these bullet points, but what we're going to be covering there is, now that we've talked about risk and you have a better handle, a better understanding, hopefully, of risk, we're going to talk about what needs to happen in order to get a quote for provider excess, specific provider excess from the commercial market. So we'll be literally walking through data requirements, product features, underwriting considerations, the pricing methodology, and in the RFP process. So hopefully you'll join us for that session as well. And now I'll turn it over to Garrett and we can get into some Q&A real quick.
Great. And by the way, I did put a link to that to register for that next webinar, the part 2, into the chat. So you should be able to do that right there. And then, of course, when we send out our little thank you email afterwards, there'll be a link to the recording as well as, and I'll put the link in there as well so that you can make sure that you register. It'll be a really good conversation as we had today. So let's jump into some audience questions. If you do have a question, by the way, go ahead and submit it now using your control module. There's a place actually for questions specifically. So drop it in there. We're going to get to as many as we can. If we don't get to yours, someone will reach out via email afterwards. So without further ado, and in no particular order here, let's go to the first question. First question is, I hear many references to stop loss coverage, excess of loss, reinsurance, provider, and provider excess insurance. Can you help me understand the differences between them?
Sure, Rick, you want me to take that one? I'd be happy to.
Yeah, go ahead.
Okay, great. So yeah, I'll try to be succinct here, but it's a great question because we do hear this term stop loss used all the time, and whether it's in the employer arena or for insurance or reinsurance, and how do we keep all this straight? So, I've been in the business for 30 years, and I think the easiest way to, to think about the different terms is to think from a regulatory standpoint. When you're dealing with provider business or employer stop loss, it is an insurance product. So that, as a result, there's substantial regulation involved. The purchaser of the insurance product, the courts are much more in their favor, if you will, from a consumer standpoint, to try to protect them. Whereas when you look at true reinsurance, I mean, that is the whole point, is it's insurance of insurance. So it is a reinsurer that is providing excess coverage for an insurance company. And not to say it's unregulated, but it's substantially less regulated. So if you look at, again, the provider marketplace and employers that are purchasing coverage, a lot of times you might hear it referred to as reinsurance, but it's really not. It's insurance. And the reason is because those entities are not recognized as licensed insurance entities. So I'll just leave it there. I'll leave it at that rather than droning on.
Yeah, no, that's a good differentiation there. It's a lot of terms here, a lot to learn. Okay, next question is, The captive approach is very interesting. Can you tell me a little bit more about the risks or what risk can be put into a captive and why it might make sense to consider that route?
I'd be happy to take that, but given the fact I chatted a little bit about captives, Rick, do you want to offer an opinion? Otherwise, I can.
Sure. I think as far as why that route might make sense, I think what I typically see, I don't see a lot of ACOs or providers or health systems setting up captives specifically for this type of provider excess risk. What I see is more often is they've already got a captive in place, and they have some other lines of business in there, and there's incremental gains that they can achieve. I mean, there's a cost to a captive, so setting up a captive just for this purpose is probably not making a lot of sense. But if you already have it there, you can get some incremental gains. And a couple of those types of incremental gain, a couple examples that we hear about commonly are slightly lower cost. So as Scott mentioned, provider excess insurance is an insurance product. It's regulated by the state. There's an insurance tax that you pay on that. Whereas reinsurance there's typically no tax on a reinsurance product. So that saves you a few points. It's not substantial, but it saves you a little bit. And then another more meaningful is because you're putting it in the captive, and the captive has these other coverages in there too, you're pooling different kinds of risk together. And often organizations will say, well, now that I have all this risk pooled together, maybe I'm willing to retain more risk and purchase at a higher deductible. So whereas maybe I would have gone with a $500,000 deductible if I was buying on its own, now that I've got it in the captive and it's pooled with all this other risk, maybe I'm more comfortable with 600,000 or 700,000 or something like that. And of course, the higher you buy, the higher the level of protection you buy, the less expensive it is, because the less likely it is that you're going to have a claim. You know, you're less likely to have a claim above 700,000 than you are above 500,000. So you're not going to be paying as much. So again, you can save some money there by not purchasing as much coverage if you go the captive route.
Yeah, definitely. Appreciate that. And the other thing is, it's just it's interesting to note that of all captives, 15% of all captives globally are actually healthcare involved, and roughly 70 to 75% of hospitals do have some form of alternative risk arrangement in place, particularly for professional liabilities. Is a big driver of that, but they're recognizing now that to the extent that they can get approval, which they have to in some states, to bring in some of these other types of risk into that captive, and this all assumes obviously that the captive is well capitalized. They're realizing that there definitely are some economies of scale and some synergies that can be obtained by pooling this risk, as opposed to leaving all of their subsidiary entities on their own to go out separately to the private or to the commercial market to purchase coverage. And of course, if they have good experience, then the margins, profits, if you will, associated, or the margins associated with that risk go outside of the organization. So really, I echo what you're saying, Rick, as far as it doesn't make sense just to set up a captive only for provider purposes, but to the extent there's already one in place and there can be economies of scale achieved, that definitely makes a lot of sense. Oh, I think you're muted, Garrett. There we go.
I was that old trick. Next question here is, and we only have a few minutes left, so in this individual reemphasized their polling choice, that they believe that the rollout of therapies is changing the system already. But can you speak to liability coverage?
From what standpoint? Related to gene therapies?
And that may be a little bit broad. If the asker, if you could restate your question, and maybe we'll try to get back to it. Next question here, we'll move on for the moment, is for provider aggregators who insert themselves between payer and individual providers, are you providing risk-sharing products for the aggregators?
You want to take that one, Rick?
Yeah, I think so. I'm thinking about I'm not sure exactly what type of, like, my mind immediately goes to like a convener type of thing. You know, you've got you know, maybe an organization that serves as a between CMS and a provider taking risk. And so if you had, or possibly it could be like a venture capital. I'm aware of it. There's venture capital firms that are investing in, say, multiple, you know, several different ACOs, and maybe they're, you know, certainly they're exposed to that risk, and perhaps they want to, if they wanted to purchase coverage that would cover multiples. I think, yeah, I think really the qualification, I mean, let's see, that entity may or may not be an insurance company. So if that entity is an insurance company or has an insurance company available to them that the risk can be transferred to, then that entity could seek coverage in the reinsurance market.
Right.
And I wouldn't really see any issue there. I think that the company should be able to get a quote in that kind of situation. If they are not an insurance company or don't have access to an insurance company, then they would need to purchase insurance, and then you would be dependent on what type of entity are you and what type of insurance are you going to be purchasing, because depending on what state you're in, depending on what types of policies the insurance companies have filed in that state, there may or may not be options available.
Right. Yeah. My quick, and this is probably too simplistic of an answer, but we're in the business of following the risk. So if legally, you know, if it's a risk that we can insure or reinsure, and just as importantly, if there's enough data for us to be able to price it, you know, if we feel confident in our ability to price it, there's enough credibility, then we should be able to offer an excess, you know, some type of an excess product, or develop one, quite frankly. As we know, you know, with the various kidney carve-outs, et cetera, you know, we've kind of held off in quoting those until, you know, maybe into next year, just because we need more data in order to be able to price it. Correct me. I've got the actuary here. I'm just a CPA, so I don't want to speak for Rick.
Oh gosh. Well, unfortunately, we are running out of time. We did have a few more questions that came in, and if you have a question, please go ahead and submit it. Someone will reach out to you through email to answer your question. But we do unfortunately need to conclude for today. So as we wrap up here, if you could go to the next slide, please. I would like to encourage all of you to visit bbcexhibithall.com and check out the Summit Re booth there. There's a lot of really great resources. There's some really neat things that you can learn more about them, what they're doing, interact with their team, and of course, reach out to them through that. But yeah, check out their exhibit booth there at bbcexhibithall.com. And then finally, if you would like to reach out to the Summit Re team, you could go to the last slide. There we go. Scott's and Rick's information is here, and this will be also on the slide that we're sending out. So when we're done here, I'm going to send out a link in about another hour or so, which will have the recording and also a place where you can download the slides. So all of this will be there for you. But if you'd like to reach out to them, please do so to get an RFP or just to have comments or questions, or feel free to reach out to me as well. I'm happy to facilitate an introduction. But I want to thank all of you again for joining us. Thank you, Scott. Thank you, Rick, for a great presentation. And hope to see you on part 2. So go ahead and register now. I'll send a link out to that as well, and it's also in your chat. But we'll see you next time, folks. Thank you.